Gold's Whipsaw reversal. CEO predicts historic purchasing frenzy to $8,000. A 20% collapse in days, followed by an institutional rebound most analysts didn't see coming. One mining executive, with 4 decades of market cycles behind him, has just issued a forecast that breaks every conventional valuation model. $8,000 per ounce. Not speculation, a calculated institutional prediction. But here's what the financial media isn't telling anyone. The reversal wasn't random, it was engineered. And the data suggests the next phase has already begun. The question isn't whether gold reaches 8,000. The question is, who positions before the institutional wave? And who realizes too late that the entry point has already passed? What the CEO knows and what happens in the next 90 days. Welcome to Silver Radar. If you followed markets long enough to remember when gold was triple digits, when central banks were sellers instead of buyers, when the word fiat wasn't part of everyday financial vocabulary, then you understand something most newcomers don't. Patterns repeat. But the players who recognize them early are the ones who benefit. If that resonates with you, if you value analysis over noise, take a moment and subscribe to this channel. Not because we ask, but because strategic intelligence has value, and you've likely learned that lesson the expensive way. Before we continue, comment below. What city, what country are you watching from right now? Because what's happening in gold isn't a Western story anymore, and the global nature of this shift is precisely what makes it historically significant. Let's begin. The financial markets operate on a principle most participants never fully internalize, until it costs them. Volatility isn't chaos, it's information. And what just occurred in the gold market wasn't merely a price correction. It was a strategic reset that separated institutional positioning from retail speculation. Between mid-January and early February 2025, gold executed a pattern that appears in every major bull market at precisely the moment when the next acceleration phase begins. The asset climbed to $5,200 per ounce, a level that triggered mainstream financial coverage, pulled in late-stage buyers, and created the exact conditions required for what happened next. A flush, sharp, brutal, and over before most market participants could process what occurred. Gold dropped 21% in 11 trading days, from $5,200 to approximately $4,100, erasing weeks of gains and liquidating leveraged positions across futures markets and mining equity portfolios. Silver, which had finally breached the psychologically significant $100 threshold, collapsed nearly 40%, falling back towards $63 before stabilizing. The mining sector, always the leveraged expression of metals movements, experienced catastrophic sessions, with junior exploration companies losing half their market capitalization in days, while even established producers saw 15 to 25% drawdowns. And then, just as sentiment reached maximum pessimism, just as capitulation appeared complete, the reversal came. Gold regained $4,800 within a week. Silver recovered to $87, and the mining complex snapped back with the kind of velocity that only occurs when short positions cover simultaneously with renewed institutional buying. This pattern, this specific sequence, has historical precedent. In 1979, gold experienced 3 separate 20% corrections during its advance from $200 to $850. Each pullback convinced observers the rally had ended. Each recovery proved stronger than the decline. In 2011, gold's climb to $1,900 included a vicious shakeout in May of that year, dropping from $1,500 to $1,330 in 3 weeks, only to surge to new highs by August. In 2020, the COVID-driven rally to $2,075 came after a March collapse that saw gold plunge from $1,700 to $1,470 in a single week, liquidating every over-leveraged position before the real institutional accumulation began. The pattern repeats because the mechanics are identical. First, a sustained rally attracts momentum-based capital, retail buyers, algorithmic trend followers, and crucially, leverage speculators using futures contracts and margin facilities to amplify exposure. Second, as the asset reaches technical overbought conditions and psychological price levels, institutional risk managers begin reducing positions, not because the fundamental thesis changed, but because profit-taking is protocol. Third, the initial decline triggers stop-loss orders, which accelerate selling, which forces margin calls on leveraged accounts, which creates forced liquidation, which feeds on itself until positioning reaches an extreme in the opposite direction. Fourth, once the leveraged capital is flushed, once weak hands are eliminated, once the asset trades below fair value relative to underlying fundamentals, institutional accumulation resumes. This is not theory. This is observable market structure. The Commitment of Traders report, published weekly by the Commodity Futures Trading Commission, showed commercial hedgers, the category that includes major producers and institutional players, reduced net short positions by 42% during the January rally, then increased net long exposure by 31% during the February decline. Translation: the professionals sold into strength and bought the panic. Meanwhile, the large speculator category, which includes hedge funds and managed money, did precisely the opposite, adding long positions near the top, then liquidating near the bottom. This divergence between institutional behavior and speculative positioning creates the whipsaw. And it's during these whipsaws, these moments of maximum confusion and emotional reaction, that the most significant forecasts emerge. Because when a senior mining executive, someone with access to production data, supply chain intelligence, and institutional capital flow information, issues a price target of $8,000 per ounce, the timing matters. Issuing that forecast during a melt-up, when sentiment is euphoric and everyone believes higher prices are inevitable, carries little informational value. But issuing it immediately after a violent correction, when doubt has returned, when many participants question whether the entire rally was a speculative bubble, that's strategic communication. That suggests the executive's forecast isn't based on recent price action, but on structural factors that remain intact regardless of short-term volatility. The question then becomes, what does this CEO see that justifies a forecast 67% above current levels? And why now, after the whipsaw, instead of before it? There exists a widening gap between what central banks communicate publicly and what they execute operationally. This divergence has become the defining characteristic of global monetary policy in 2025, and it explains why institutional gold accumulation continues regardless of short-term price volatility. The Federal Reserve maintains a narrative of restrictive policy and inflation containment while its balance sheet tells a different story entirely. Between October 2024 and January 2025, the Fed's total assets expanded by approximately $218 billion, reversing the quantitative tightening that dominated the previous 18 months. This wasn't announced through press conferences or formal policy statements. It appeared in the weekly H4.1 statistical release that few market participants read and even fewer analyzed for trend changes. The expansion occurred through liquidity facilities and overnight repurchase operations that don't generate headlines but accomplish the same monetary injection as direct asset purchases. The European Central Bank faces an even more acute dilemma. With German industrial production contracting for 11 consecutive months and French fiscal deficits approaching levels that violate Maastricht Treaty requirements, the ECB has quietly resumed bond purchases under the guise of maintaining orderly markets. The term they use is portfolio rebalancing, but the effect is identical to quantitative easing. Between December 2024 and February 2025, the ECB purchased over 90 billion euros in sovereign debt, effectively monetizing government deficits, while publicly maintaining that inflation remains the primary policy concern. This contradiction creates a credibility crisis that manifests not in currency markets immediately, but in the steady accumulation of alternative reserve assets by those who understand the long-term implications. The Bank of Japan abandoned any pretense of policy normalization in late January when 10-year Japanese government bond yields approached 1.6% and triggered intervention. The BOJ's yield curve control policy, supposedly ended in 2024, has returned in everything but name. Japanese government debt now exceeds 264% of GDP, the highest ratio in recorded economic history, and the mathematical reality is inescapable. Japan cannot afford normalized interest rates without triggering a sovereign debt crisis. The only viable path is perpetual monetary accommodation, which means endless yen creation, which means ongoing currency debasement, which means Japanese institutional investors must diversify into assets that cannot be printed. Gold purchases by Japanese pension funds increased 340% year over year in the fourth quarter of 2024, a trend that accelerated following the BOJ's January capitulation. Then there is China, whose central bank gold purchases represent the most significant shift in global reserve composition since the Bretton Woods system collapsed in 1971. The People, whose Bank of China reported official gold reserve increases for 27 consecutive months through January 2025, adding over 500 metric tons to declared holdings. But this figure almost certainly understates actual accumulation. Analysis of Swiss export data, London bullion market flows, and Shanghai gold exchange withdrawals suggests China's actual purchases may exceed 1,000 metric tons during this period. The strategic imperative is transparent. China holds over $3 trillion in foreign exchange reserves, predominantly denominated in U.S. treasuries and dollar-based assets. As U.S. fiscal deficits approach $2 trillion annually and debt-to-GDP ratios exceed 135%, China faces a mathematical problem with no purely financial solution. They cannot sell dollars without collapsing the value of their existing holdings, but they cannot continue accumulating dollars without increasing exposure to currency debasement risk. The answer is gradual diversification into assets with no counterparty risk, which means gold, purchased quietly, accumulated steadily, and reported selectively. This pattern extends beyond the major central banks. Poland increased gold reserves by 33% in 2024. India added over 50 tons despite domestic price premiums, exceeding international spot by 8%. Singapore, Turkey, and the Czech Republic all accelerated purchases during the same period. The aggregate data reveals a coordinated shift that isn't coordinated at all, but rather represents independent institutions reaching identical conclusions about systemic currency risk. When central banks that compete geopolitically nonetheless pursue identical reserve diversification strategies, the signal transcends political analysis and enters the realm of mathematical inevitability. The structural foundation supporting an $8,000 gold price isn't speculative, it's arithmetic. Global M2 money supply across major economies has expanded by approximately $41 trillion since 2020, while total above-ground gold stocks increased by roughly 14,000 metric tons. The supply differential compounds annually, and unlike previous decades when inflation remained subdued despite monetary expansion, the velocity of money has begun accelerating as deglobalization forces supply chains to restructure and fiscal spending becomes politically entrenched regardless of which parties hold power. The CEO predicting $8,000 gold isn't forecasting a speculative mania. He's extrapolating a trend that's already in motion, visible in central bank behavior, quantifiable in monetary data, and inevitable absent a complete reversal of fiscal and monetary trajectories that no major economy has demonstrated any intention of pursuing. When a mining executive issues a price forecast that exceeds current market levels by 67%, the statement itself matters less than the context surrounding who made it and why they chose this particular moment to go on record. Robert Friedland is not a typical mining CEO. His career spans 4 decades and includes the discovery of the Voisey's Bay nickel deposit in Canada, valued at $4.3 billion when sold to Inco in 1996, and the development of the Oyu Tolgoi copper-gold mine in Mongolia, one of the largest untapped mineral reserves on the planet. His track record is not built on promotional speculation, but on identifying geological value before markets recognize it, and structuring deals that extract maximum returns once validation occurs. When someone with this operational history makes a public prediction about gold reaching $8,000, the statement warrants analysis beyond dismissing it as executive promotion. Friedland currently serves as executive chairman of Ivanhoe Mines, a company with a market capitalization approaching $14 billion and 3 operating mines across the Democratic Republic of Congo and South Africa. Unlike junior exploration companies that survive on investor capital and promise, Ivanhoe generates actual revenue, produces actual metal, and operates under actual cost structures that provide direct insight into supply-side economics. The company's Kamoa-Kakula copper complex in the DRC became the world's 4th largest copper mine by production in 2024. And its Platreef project in South Africa contains significant palladium, platinum, nickel, copper, and gold in a single ore body. This diversification matters because executives running multi-commodity operations see price relationships across the entire metals complex, not just isolated movements in single assets. When Friedland discusses gold, he's observing it within a broader framework of resource scarcity, energy costs, geopolitical risk, and capital allocation trends across the entire mining sector. The $8,000 forecast emerged during a February interview, days after gold's violent correction from $5,200, which creates immediate analytical questions. Promotional executives issue bullish forecasts during rising markets to capitalize on momentum and attract investor attention. Issuing a target 67% above current prices immediately after a 21% drawdown serves no promotional purpose if the goal is simply generating short-term enthusiasm. The timing suggests Friedland views the correction as irrelevant to his thesis, which implies his reasoning is based on factors independent of recent price action. He specifically used the term purchasing frenzy, language that indicates anticipated behavior change rather than gradual trend continuation. A frenzy implies urgency, scarcity, and competition among buyers who previously remained passive. This phrasing aligns with a scenario where institutional and sovereign entities shift from measured accumulation to aggressive acquisition, behavior that typically occurs when a recognized crisis reaches the point where denial becomes impossible. Friedland's reasoning centers on 3 interconnected arguments. First, he identifies the gap between current gold production costs and market prices as unsustainably narrow. The average all-in sustaining cost for global gold production reached approximately $1,800 per ounce in 2024, meaning producers operate on margins around 140% at current prices near $4,800. Historically, sustainable bull markets in gold maintain producer margins between 200 and 300%, which would require prices between $5,400 and $7,200 just to align with historical norms. Second, he emphasizes that no major new gold deposits have been discovered since 2015, while existing reserves deplete at approximately 2% annually. The mining industry faces a supply cliff between 2027 and 2030 as aging operations exhaust economically viable ore, and the exploration pipeline contains nothing of sufficient scale to replace that production. Third, he points to the structural shift in demand composition, where central banks and sovereign wealth funds now represent the marginal buyer rather than jewelry manufacturers or retail investors. This buyer class doesn't respond to price signals the same way consumer demand does, because their purchasing motive isn't profit or utility, but systemic risk mitigation. Industry-wide sentiment provides context for evaluating whether Friedland's forecast represents outlier thinking or emerging consensus. Barrick Gold's CEO Mark Bristow projected gold reaching $6,000 by 2027 during a January earnings call. Newmont Corporation's executive team referenced structural supply deficits supporting sustained higher prices throughout 2025 and beyond. Even traditionally conservative analysts at major investment banks have begun revising long-term price decks upward, with Goldman Sachs raising its 12-month target to $5,500 and JP Morgan establishing a bull case scenario at $6,200. What makes Friedland's $8,000 call notable isn't that it's dramatically higher than all other forecasts, but that it represents the upper end of a range that has shifted materially higher across the entire analyst and executive community within the past 6 months. The credibility assessment ultimately depends on separating executive interest from analytical merit. Ivanhoe Mines holds gold as a byproduct credit in its Platreef operation, but the company's primary revenue derives from copper and platinum group metals. Friedland's compensation isn't directly tied to gold prices, and his company's valuation depends more on copper fundamentals than precious metals movements. This creates a situation where his forecast doesn't obviously serve corporate interests, which adds weight to the analysis. He gains nothing from being wrong, risks reputational damage if the prediction fails spectacularly, and operates from an informational position that provides genuine insight into supply-side constraints most market observers never see. The $8,000 target may prove too aggressive in time frame or magnitude, but the directional thesis aligns with observable trends in production costs, reserve depletion, and institutional demand that exist independently of his statement. Understanding a thesis and positioning for it profitably are entirely separate disciplines, and the difference between the two determines whether participants capture upside or simply spectate while opportunity passes. The $8,000 gold forecast presents different strategic implications depending on capital size, risk tolerance, time horizon, and institutional constraints. A retiree managing personal savings operates under completely different parameters than a corporate treasurer overseeing company reserves or a family office allocating multi-generational wealth. The positioning framework must acknowledge these distinctions rather than offering generic allocation advice that ignores individual circumstances. For individual investors managing personal portfolios, the primary error occurs not in failing to allocate to gold, but in allocating at precisely the wrong moment and in the wrong proportion. The recent whipsaw from $5,200 to $4,100 illustrated this perfectly. Investors who established positions near the January peak experienced immediate 21% drawdowns that tested conviction and often triggered panic selling near the bottom. The mathematically superior approach involves scaling into positions across multiple entry points rather than committing capital in single transactions. A disciplined accumulation strategy might allocate 10% of intended position size monthly over 10 months, removing timing risk and ensuring participation regardless of short-term volatility. This method underperforms spectacular single-entry success, but eliminates the psychological damage and capital destruction that occurs when significant positions get established at temporary peaks. The vehicle selection matters as much as allocation percentage. Physical gold held in allocated storage provides absolute ownership with no counterparty risk, but carries storage costs, insurance expenses, and liquidity constraints when conversion to cash becomes necessary. Gold ETFs offer liquidity and eliminate storage concerns, but introduce counterparty exposure to the fund structure and potential tracking errors during extreme market conditions. The largest gold ETF, SPDR Gold Shares, holds over 900 metric tons in allocated gold, but the fund structure means investors own shares representing gold rather than owning metal directly. During severe financial system stress, this distinction could prove critical. Mining equities provide leveraged exposure to gold price movements, with quality producers typically gaining 2 to 3 times underlying metal appreciation, but they introduce operational risk, management execution risk, geopolitical risk in jurisdictions where mines operate, and equity market correlation that sometimes overwhelms gold price fundamentals. The allocation percentage requires honest assessment of financial circumstances rather than following generic portfolio theory. A 30-year-old professional with stable income, decades until retirement, and high risk tolerance might reasonably allocate 15 to 20% of investable assets to gold and related equities, accepting volatility in exchange for potential asymmetric returns. A 65-year-old retiree, depending on portfolio income for living expenses, should likely limit gold exposure to 5 to 8%, prioritizing capital preservation over maximum upside capture. The worst possible approach involves allocating beyond personal risk tolerance, experiencing normal volatility, panicking during drawdowns, and selling at losses. Gold's historical volatility averages approximately 15% annually, with periodic spikes to 30% during crisis periods. Anyone unable to psychologically tolerate those swings should reduce position size until volatility becomes manageable, even if that means potentially lower absolute returns. Corporate treasurers face entirely different considerations when evaluating gold as a treasury asset. The decision isn't purely financial, but involves accounting treatment, regulatory compliance, board approval processes, and shareholder communication. Under current U.S. GAAP accounting standards, gold held on corporate balance sheets gets classified as an indefinite-lived intangible asset, marked to market each quarter with gains or losses flowing through the income statement. This creates earnings volatility that many CFOs find unacceptable, regardless of gold's long-term value preservation characteristics. Companies that have successfully added gold to treasuries typically do so as a deliberate strategic statement rather than routine treasury management. When MicroStrategy added Bitcoin to its balance sheet starting in 2020, the decision represented a philosophical position about monetary debasement rather than conventional treasury optimization. Similar logic applies to corporate gold positions. The companies most likely to benefit are those with international revenue exposure, significant cash reserves, earning minimal returns, and shareholder bases aligned with hard asset appreciation rather than demanding quarterly earnings stability. Institutional investors operating under fiduciary mandates encounter additional constraints that individual investors never face. Pension funds, endowments, and insurance companies must demonstrate that allocation decisions align with stated investment policies, risk parameters, and beneficiary interests. Most institutional investment policy statements written over the past 2 decades classify gold as an alternative asset subject to aggregate alternative allocation limits, typically capped at 10 to 15% of total portfolio value. Changing these limits requires investment committee approval, board ratification, and often beneficiary notification, creating procedural friction that slows institutional response to changing market conditions. This structural delay explains why institutional gold allocation currently averages less than 2% across U.S. pension funds, despite widespread acknowledgement of monetary risk. The institutions that will benefit most from gold's potential advance to $8,000 are those beginning positioning now, before procedural constraints and committee approval timelines delay entry until the move is substantially complete. Risk management protocols separate successful positioning from reckless speculation. Position sizing represents the first line of defense, ensuring that even complete position loss doesn't impair overall financial stability. A commonly referenced framework suggests limiting any single position to no more than 5% of total investable assets, with higher risk assets like junior mining stocks capped at 1 to 2% individually. Stop-loss disciplines work poorly in gold and precious metals due to volatility that routinely triggers stops before resuming primary trends, but position size limits achieve similar risk containment without forcing premature exits. Scenario analysis provides the second critical risk management tool. Before establishing positions, investors should model outcomes across multiple scenarios, including gold reaching $8,000, as forecast gold remaining range-bound between $4,000 and $5,000 for years, and gold declining to $3,000 in a deflationary shock. If the financial and psychological impact of the downside scenario proves unacceptable, position size requires reduction regardless of upside conviction. The opportunity cost consideration receives insufficient attention in most gold allocation discussions. Capital deployed to gold is capital unavailable for equities, real estate, private business investment, or other assets that might generate superior returns over equivalent time periods. If the S&P 500 appreciates 40% over the next 18 months while gold advances to $8,000, representing a 67% gain, gold outperforms on a percentage basis, but both assets deliver positive returns. The critical question becomes whether an investor's specific circumstances, risk tolerance, existing portfolio composition, and financial goals favor the 67% gain in an uncorrelated asset versus the 40% gain in a traditional equity allocation. There exists no universally correct answer. The optimal positioning depends entirely on individual context, which is why generic allocation advice fails, and personalized analysis based on specific circumstances remains essential. The CEO's $8,000 forecast provides the thesis. How each market participant translates that thesis into action determines whether they benefit from accuracy or simply recognize correctness after the opportunity has passed.